What's your favorite movie and why?
It's so hard. I have to be original to myself. Caddyshack. I have to.
So I got that going for me.
Yeah. Gunga Galunga.
Welcome to the On the Edge podcast with your host, Scott Groves. Hey, ladies and gentlemen, Scott Groves here with the On the Edge podcast. I'm here with my buddy, Tim. We've known each other online for a long time and known of each other. Tim is the president of Ross Mortgage, which is a regional mortgage bank in the Midwest. They're out in 22 states. And this year's goal was to bring more business conversations to the podcast, more real estate, mortgage, stuff like that. And the mortgage industry is pretty crazy with a lot of companies merging. And I keep hearing this word balance sheet when I talk to mortgage people and mortgage C-level individuals, because a lot of mortgage companies don't currently have a healthy balance sheet. So they either have to decide to stop doing loans or merge or raise capital or whatnot. And the reason I wanted to talk to Tim is because Ross Mortgage has been around for 75 years. And that might not seem like a lot, but there's not a lot of mortgage banks that have been around for 75 years. Large banks, the Wells Fargos of the world, who have depository relationships and investment banking and et cetera, they stick around for a long time because they're well capitalized. But mortgage banks that have come and gone in a decade, they are kind of a dime a dozen. So thanks for jumping on, Tim. And yeah, man, let's hear a little bit about your background. And then I want to get into all the nitty gritty mortgage stuff of like why a company like your size can still thrive and exist in this market, like how you guys have made it through 2009 and 2001 and 1991 and have this 75-year track record, because there was a vast majority of mortgage companies didn't make it out of that time frame. So tell us where you're calling in from, kind of what your background is, because I don't know a lot about you personally.
Yeah, no problem. Well, first off, thanks for having me. I appreciate it. I'm calling from Metro Detroit, a little city called West Bloomfield, Michigan. So it's about 40 minutes north of the airport. Why we're still here? That's a great question. I think it's, everyone back in early 2000s and even now, every independent mortgage bank wants to hit $1 billion. That for the longest time, that was like the IMB's staple. You got to hit $1 billion. You got to hit $1 billion. I think that we're still around because we never did. Not one time have we closed $1 billion in originations in 1 year. And I'll explain that a little bit. So long story short of why we're celebrating 75 years. This company was started in 1983, and I know the math doesn't add up, but I'll get to it, by Tim Ross, my CEO, and his father, Hugh Ross, God rest his soul. And in 1980, now just for the record, that was still 41 years ago.
Yeah,
that's still pretty good. In 1986, we bought Michigan First Mortgage. And what happened was we bought them and their servicing. And in order to continue their servicing, we couldn't dissolve them. So we had to dissolve us and then rename Michigan First Ross Mortgage Corporation. That was literally 38 years ago. So ever since then, we've been this small IMB out of Metro Detroit. I started in 2001. No, I apologize. I started in 2002. Yes, I started in 2000. No, I did start in 2001. What am I talking about? I started in June of 2001. I was the loan officer assistant. Funny story. A guy who's the top producer in my company, one of the top producers in my company today, is who hired me. And what happened is 90 days after he hired me, I accidentally got his paycheck. And when I saw how much he made, it took me about 4 days to gain up the courage to come into him and say, hey, I'm not going to be your assistant. I'm going to be a loan officer, but I'll work in your branch. So from there, I was a top producer for about 11 of those years. I ran about a $220 million branch for about 5 or 6 years. And then in 2017, I became the president of the company.
Awesome, man. And there's so much baked into there. That $1 billion number that every mortgage bank wants to get to, and then they try to go to 2 billion and 3 billion and whatnot. Is that just ego? Is it a big boy number in the sense that like then you can have bragging rights? Or are there things that happen as a mortgage company? Like, I don't know, it gets easier to sell loans to FHA or something if you're doing $1 billion, or is that number just an ego thing? Like every loan officer I talk to is like, I want to make $1 million. And I'm like, okay, that's super cool.
Yeah.
Why?
Yeah.
And they never have an answer for the why.
No, it's such a good question. My short answer is it's an ego thing. It's an ego thing. Because here, let me ask you a question. And I didn't learn this until I became president of the company. When I became president of the company in 2017, that was my goal. I'm going to build this thing. We're going to be $1 billion company and blah, 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 blah. The bottom line is everybody has an average loan balance, and everybody has to do a certain amount of units of that average loan balance to hit $1 billion. There's a very simple but yet complex algorithm that you can basically run a pro forma and determine what you're going to make. So let me ask you a question. If you were running a company and every loan you do is a risk, right? Every loan we do is a risk. We can buy it back, not sell it, make a mistake, whatever it may be. If I told you at $750 million, you could make $1.5 million a year. But I told you at $1.2 billion, you can make $1.5 million a year.
Yeah.
What would you do?
Hard pass.
Exactly. And I think that Ross has always put ourselves in a situation where we're not going to make the most in the mortgage industry, but we're always going to succeed and we're always going to be around. And for that, our average tenured employee, both loan officer and operations, over 11 and a half years.
That's amazing.
So
I mean,
we're just always around.
No, that really speaks to company culture or retention or golden handcuffs or something, because the average loan officer, I think, moves companies every 4 years, right? So if you're almost 3 times that average, that's amazing. That really speaks highly of the company.
Yeah, and I'll tell you right now, the loan officers drag that number down.
Yeah, of course they do. Hey, this quick interruption is brought to you by me, Scott Groves, the host of the On the Edge podcast. This podcast is brought to you by me. I'm a loan officer who can help you with a mortgage in all 50 states across the United States. I also coach loan officers. So if you are a home buyer who's looking to get a mortgage, if you're a realtor who's looking to partner with an awesome loan officer, or if you're a loan officer looking for coaching, get in touch with me. It's those sources of revenue that allow us to produce this podcast and get out a new episode to you every week for the last couple of years. So if you're looking for a mortgage, if you're looking for a mortgage lender to partner with, or you're looking for a mortgage coach, I'm your guy. Now back to your regularly scheduled programming. You mentioned something that I want to define, because in the mortgage industry, we kind of talk about it passively or just kind of as a throwaway line. But you mentioned that when you absorbed the other company, Michigan First, you had to absorb their servicing portfolio. I'm sure right now a big part of your financial strategy is managing your servicing portfolio and what that looks like, and when do we sell loans and when do we do this. And then there was the law where you had to mark to market and all this crazy stuff. Can you explain to the novice what a servicing portfolio of loans are?
Well, I want to make sure I'm fully transparent. I'm not servicing right now.
Oh, okay. You're not.
I want to make sure. Yeah. So in 96 or between 1996 and 1999, they sold all their servicing and haven't gotten back in it yet. Now, we are actually right now in the middle of trying to get back into it. But the biggest thing about servicing for an IMB that you have to understand if you're a loan officer, because a lot of people, it's funny. When I took on this position I'm in now in 2017, I thought I was so smart. As a loan officer, I was a top producer, killed it at a branch level, killed it as a loan officer. There's nothing I can't do. We know 1/10 of what goes into running a mortgage, an independent mortgage bank. The biggest thing about servicing that people have to understand, in order for your company to service, they have to give up a lot of capital. There is a lot of capital you have to give up. For example, when an IMB who doesn't service sells a loan, they get paid 2 times, maybe 3 times, right? If they hedge it, they get paid gain on sale, which isn't always a pay. It's a loss or a positive. They get a yield spread, which is basically what they're going to pay for the rate. And then they get a SRP. They get a servicing pricing, right? If you decide to service the loan, you give up your SRP. So if you think about it, an IMB's got to have a lot of capital to be able to give up 1/3 of how they make money. Now, it always doesn't equal 1/3. I don't want to say that, but one stream of revenue you have to give up. Now, the people who serviced going into 2020, if they're honorable people, they will tell you they had no idea that they were about ready to hit the jackpot. I mean,
right.
As a matter of fact, in March and April of 2020, they all thought they were going out of business because of margin calls.
Right.
And they all hit the absolute jackpot, because that servicing, we didn't know at the time that servicing would have an average age of over 7 or 8 years.
Right.
So,
and just to step back real quick, when we're talking about servicing, so you're collecting the mortgage payment and you're doing all the stuff, right? So most mortgage banks, we write the loan and then we sell it to a mega servicer, like Mr. Cooper or something like that, or Wells Fargo or whatnot. And then they get paid to service the loan, send out the mortgage statement, pay the taxes, pay the insurance. And if you happen to be in that boat where you were a mortgage company that were servicing loans, and then everybody and their brother refinanced in 2020, 2021, you can usually plan on those loans being on the books for 4, 5, 6, 7 years that you're going to make that servicing income. But now somebody has an interest rate at 3%. you're keeping that loan forever, right? Like you're getting paid on that loan as servicing forever, because unless there's death of a family member or something, they're not going to sell that house.
Yeah, no, absolutely. It's very valuable right now. What's not valuable right now, and it's showing up in what companies are willing to pay us in SRP, is rates today. Nobody wants these.
Nobody wants to service the loans that are being written today.
Yeah.
Why is that?
Well, because they're short term. I mean, all it would take is rates to go to 6, and every loan that was done in the last 18 months would be refinanced.
Yeah.
Now the big servicers who have a real dialed in CRM, they have a real dialed in way to keep it, they'll still give you some money for it because they're convinced they can make them switch on their own. That's what I tell all my loan officers for the last 3 or 4 months. This next refi boom is going to be really different. It's going to be really different than 2020. It will not be the same. I don't guarantee anything, but I can strongly recommend it will not be the same.
And I'm guessing that's because it'll be cutthroat and the servicers will cut the price to the bone. They will give away loans at a lower interest rate because, let me just think this through. Ross Mortgage, I'm going to use round numbers. Ross Mortgage writes a loan at 7%. They sell it after the close of sale. You get your SRP and it goes to servicer ABC. So now the client's getting their mortgage statement and company ABC is servicing that loan. For it to make sense for them to own that loan, they have to own it for many, many years in order to make their money back. 4 years. Okay, they got to own that loan for at least 4 years to make sense for the money they paid you to buy those servicing rights. So let's say it's December of 2024, rates go to 6. That servicer is going to be hounding their own client saying like, hey man, we'll give you 5.875, 5.75. We'll cut anybody's knees out from underneath them because we want to keep the loan for another 4, 5, 6 years so we make our money back. Because we already paid 100%. Tim over at Ross Mortgage to take the money from us or to take the loan from us. So we got to really keep this loan. And it's going to be, I think it could be a bloodbath. I think a lot of people are sticking around thinking like, oh, there'll be easy refinance business. And it's like, no, it will be hyper competitive with every call center, with every servicing department. I mean, it'll be brutal. You'll be fighting harder for the refinance loans than you are the purchase loans.
You need to any loan officer that wants to make a career out of this business needs to focus on garnering relationships that bring you purchase business. The bottom line is, I just think what made 2020 so special, it was insane, right? In my 24 years, 3 years, whatever it is, I've never experienced anything like it. I've never been able to make that kind of money on refinances. Never did I have, we were closing 260, 200, almost 300 loans a month, and we were making the same on refis as we were purchases. That's insane. And loan officers have to understand that will not happen. The only reason we were doing that is because A, the servicing was so good because they knew these rates were so low and they weren't going to go anywhere. And B, there was so much of it, the servicers didn't want it.
Right.
They didn't want it. They were like, dude, we can't refi anyone. We just got to keep buying what we can. We got to let Little Ross Mortgage do all the work and we'll just buy it back, when the time comes. And that was the biggest perfect storm. But I know you've been in it for a long time. You remember pre-2010 when we used to make a percentage of the revenue. Never did I try to make the same on a refi as I did a purchase.
Right.
And we were doing it for 24 straight months.
Yeah.
And that's what made it so insane. I tell people all the time, I'm like, listen, you'll do as many units as you did in 2020 some other time again. Let's face it, it's a cyclical business. At some point in the next 10 years, we'll have a 2020 and 2021. You'll never be able to make the revenue you made on these loans.
Right.
Never. So that I strongly believe.
Let's talk about the revenue because, loan officers are either so arrogant or ignorant or they've never run a business themselves. They don't understand overhead and salaries and whatnot. And it's like, I've asked before of leadership at companies I've worked for. I'm like, I get it, man. I know you guys have a lot of overhead. I know you have to make a profit to stay in business because you're not here saving the whales. Like you're selling a financial product. Obviously, we're doing this for cash, right? So if we're in a scenario where the loan officer is making 100 basis points. What do you guys have to sell the loan for on the back end to keep the lights on, pay for the condo department, pay for the marketing, pay for the assistant, pay the payroll taxes, a million different expenses that go into running a mortgage company? And then, of course, you guys have to have a profit, right? And you've got to be saving money for a rainy day, and you've got to be keeping the balance sheet healthy. Is it like, if a loan officer is making 100 bips, does that mean the company has to make 3x, 4x, 5x that much on the execution of the sale of the loan? Or is there kind of a magic formula for you guys of like where we can stay in business?
Well, the beautiful thing about Ross, and I'm not trying to make it all about Ross, but the beautiful thing about Ross is we're this whole transparency thing these loan officers want crack me up. Because first off, if you're any type of IMB, you hedge your business anyway. So there is no transparency because you don't know what you're going to make until about 40 days after the loan closes anyway. So it doesn't even...
Okay, you got to explain those for the people in the back, because this always makes me laugh when we have the transparency conversation, that you guys are taking a major gamble on what you might make.
Yeah. So there's two types of way to sell loans, right? Mandatory or best effort. Best effort, I could be completely transparent with you if I wanted to. Hey, listen, here's my gross price. It's a $200,000 loan. I'm trying to make 3, give you 1. Your branch needs this, and we need this to survive. Away we go, right? But most IMBs, good ones, hedge everything. So literally, we just put it on a hedge, and we wait. And if the market goes up, we're protected by broker dealers. And if the market goes down, we owe the broker dealers. But we never know until we sell them after the fact. So this whole transparency thing cracked me up. Here's the bottom line. In America, it costs $9,700 to originate a loan. And it's the average for the MBA to originate a loan. So so to ask, do I need to make 1x, 2x, 3x, 4x? It depends on the loan size. I mean, if you do a $500,000 loan, I just need to make 1 point. You make 1 point, I make 1 point, we all walk away and everyone's happy. If it's a $100,000 loan, I need to make like 450 to 5 points, So, I mean, it's just, I wish basis points wasn't so prevalent in the loan officers' minds, because it doesn't matter. What matters is cash. How much revenue is it driving? I think that loan officers, and I want to make sure everyone understands, I closed 7 loans this month. I still originate, right? If you can't look in the mirror and admit that when we came out with how we were going to pay ourselves in 2010, and for the most part, I would probably say 90% of the loan officers in the industry, it's still the same, but yet the average loan size in 2010 was 120, and now it's over 300. We got a raise.
Yeah.
A pretty big one too. So I just think that this next refi boom, I hope it, as much as I cannot believe I'm saying this, I hope it takes a little bit longer, because we got to continue to weed out the ones that just shouldn't be in the industry.
I totally agree. Make it harder for about another year. You and I have both seen Barry Habib speak recently where, depending on how you slice the numbers, because there's a lot of people that have a license that don't originate loans. Maybe they're managerial class at a bank or something like that, or they work at a bank and they do investments, but they also have to have a mortgage loan. But any way you slice it, at the height of things, there's an estimated, 330,000 loan officers at the height of the COVID refinance boom. And Barry's most recent numbers are like, there's 80,000 loan officers who have funded a loan in the last 90 days. And you and I know a loan officer who only did 1 loan in the last 90 days. They're not living off of being a loan officer. They're on their way out. Maybe they still have their license and they're throwing in a few deals, but they're already selling gold chains at the mall or solar, 100%. Or they took a middle management job somewhere at a bank. So maybe there's 60 or 70,000 loan officers left who are actually producing at a decent level. And I wouldn't mind if that number goes in half again, so that by the time the next refinance boom hits, all of that windfall money comes to the people who were professional and lasted.
Yeah, 100%. I think the golden is 50,000. If we can get under 50,000 the next time it's big, I think that could be huge for us.
There we go. I'm going to start telling my coaching clients 50,000 LOs or bust. Like just make it into the top 50,000. That's a lot of space to survive.
Yeah. And it's funny you say that about the ones. I mean, every company, and I'm not excluded from this, has loan officers that don't produce. And it's funny because I'll tell you what, I got top producers that I struggle so bad to get them to come to the sales meetings and everything else, but they're great and I love them and they're loyal to me and I'm loyal to them and they're awesome. But And I got some producers that haven't done loans this year that show up to every sales meeting. I just don't know what. I just don't know. I just don't know. I want to try to help them because those are the ones you want to help, the ones that are putting in the effort,
right?
And you got to ask them and yourself, like, am I doing something wrong? Are they doing, like, what are you doing wrong that's not connecting? Because man, they soak it up. And then you got the ones you never see,
right?
And then you got the ones you never see. And I'm with you. I'm assuming they're doing something else.
Right.
Right.
Yeah. And what, you mentioned this $9,700 to originate a loan. Can you walk through some of the costs that are maybe known and then maybe some of the hidden costs that your average loan officer doesn't understand? Like, it costs $10,000 to generate a loan. What does that encompass?
I think the biggest misconception from the loan officer community, and I hear it all the time. I mean, brokers made a living trying to convince everyone this was true, is that middle management and the executives take all the money.
Right.
That one just cracks me up. I wish that was the case, because if that was the case, I'd be retired by now.
Right.
The bottom line is one of the most expensive things that loan officers don't understand is compliance. Compliance is expensive as all get out. I mean, you got just really. I mean, I got audited by a state. I won't say names or anything like that, but I got audited by a state where I did 6 loans in the last 2 years. But I'm licensed in the state. I did 6 loans. It's going to cost me $15,000 to be audited by the state.
Ugh.
I got.
And by the way, that's not an audit because you did anything wrong. That's just normal, compliance. We're checking this box this year, this 36 months.
All the money you spend on internal, because we internal audit the heck out of ourselves, right? We always want to make sure that we're checking our own pulse, right? Internal audits are so expensive. Audit people, QC people are expensive. I mean, loan officers typically, and rightfully so, I was the same way. I focus on processors, underwriters, closers, every now and then post closers, and my assistants. I don't focus on anything else. Well, that makes up 1/5 of my company. Right. I mean, like everything else, a tech is so expensive. So expensive. That's the thing that I'm shocked hasn't gone way up. The average origination fee without discount or anything else, I think is somewhere $1,700 or $1,750, something like that. I'm blown away that isn't over $2,000. You know how many mortgage companies could solve all their issues if they just made that $2,250?
It's crazy because as long as I've been doing this, I remember probably mid 2000s, 2005, 6, somewhere like that. Everybody was shocked that the underwriting and processing fee or the hard costs of the loan went above $999. Oh, it's going to cost more than $1,000. I'm going to lose so many clients, blah, 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 blah. Yeah. I have told every mortgage company I've worked at, especially with the loan amounts I play, average loan amount in Las Vegas, 500,000, average loan amount in LA, 800,000. Nobody gives a shit about the closing costs. Like whether their closing costs are 10,000 or 10,500, it's a rounding error on, and I mean closing costs as far as like prepaid taxes, all that stuff. It's a rounding error in the grand scheme of buying a house. I have begged like regional managers, divisional managers, CEOs. I'm like, hey, if we have a profit problem or if we have a cost problem or if we need to lay people off and we did thousands of units last year, raise the cost by $400, an extra $500,000 in costs shores up a lot of jobs and they just won't do it.
Funny. It's so funny.
It's wild.
Scott, I'm in that boat. I will tell someone they got to cut their commission. I'll tell someone they got to do this. I get scared when I go tell my people I'm raising that fee $50. Because I don't know. I think it's just because I was a loan officer first and I always hated it. But you're right. In 2009, the average was $1,200. And now 12 years later, with inflation at one of the all-time highs, and it's only $1,700.
Hey, Chris, do me a favor. Look up what the because I remember when this happened in 2007, it went over $1,000. What's the cumulative inflation over the last, call it 15 years, 17 years, something like that? Yeah. I would be willing to bet, groceries, pretty much everything except for like maybe cell phones and TVs have inflated by 70, 80% over the last 15 years, probably over 100.
According to Google's AI, which is smart asset, from 2004 to 2024 is 66.08%.
For all products, all things.
Yeah, with an average inflation rate of 2.58 each year.
All right. So yeah, I cannot believe that the cost to do a loan isn't $3,000 because, you know, my first insurance policy on my first house in Pacoima, California was $350 a year. And now you cannot get homeowners insurance in California for under $3,000 a year. So it's like, I mean, this is just cost of doing business.
And think of how easy it would be to solve so many problems. Can you imagine if all these IMBs that are struggling, just like, I mean, $300 more alone? That would be massive. That's your underwriting department.
Yeah.
You know, but God forbid we put it up to 1990 instead of 1750. You know, so it's. I mean, I understand it. I do. It's cutthroat. The broker community. You know, if you're part of any Facebook group anywhere, the broker community, although they still only represent 21% of the business, they're the loudest on social media. They're super good, super aggressive. I got no issues with the broker model, but I do politically correct. I think they have an unfair advantage in how they can price loans.
Yeah,
I think when the refi booms come, they'll take bigger advantage of it than IMBs for sure.
You know, I do have I can say whatever I want because it's my podcast. So I do have a bone to pick with the broker community. At the height of all the infighting, which was just silly, man. It's like, dude, we got bigger fish to fry than fighting about whether Ross Mortgage versus Synergy One versus Movement versus Joe Blow Broker, like who's better. Like, oh God, dude, there's just so much more interesting stuff to talk about and so many more interesting ways to grow business. At the time, about 4 years ago, when this was at the height of its craziness, maybe 5 years ago, my partner Justin and I, you know, we were doing about $180 million a year in business just between the two of us. And we were doing a lot of non-QM. We were brokering out a ton of jumbo business. So I think at the time we were at New American Funding. New American Funding, like in their servicing portfolio, conventional, FHA, government, all the stuff that they did in-house was maybe half of our business. And so all these people were just mouthing off. I'd look up their production and I'd be like, hey, I just want to let you know, working at a mortgage bank, my partner and I, Justin, we brokered out 4 times as many loans as you did last month. So you can talk all the smack you want, but I'm actually a better broker than you. We're brokering out more deals working at an IMB than you're funding. And it's just been a race to the bottom with that argument that I can't accept. I can't accept. And you know, even if it made sense for me to go open up my own shop, hang my own shingle, and be a broker, because of the attitude amongst those people and the people that lead that group, I don't think I could go be a broker like out of principle. It's like I just can't be a Clippers fan. I'll always be a Lakers fan.
I love that. No, I could never do it either. I mean, I had opportunities. Obviously, we both have had opportunities in the past. I don't care what anyone says. If I was going to do this as a side hustle all day long, like be a broker all day long. Why wouldn't I?
Yeah.
Work out of my freaking basement, make a couple $1,000 alone, get a couple in, and then have a full-time job. No problem. My goal was units. I wanted to close 300 units in a year. That was always my goal, right? And I think the closest I ever came was I got to like 268 or something like that one year. So my big thing was I needed the support. I wanted that, and I needed the support, and I got the support, you know. And the other thing about this industry that just kills me is the job hopping. I think these guys, I mean, I love people that are like, oh man, even good loaners. Oh man, I never got to where I wanted, or how'd you get where you wanted? You know, how'd you get to where you are? I'm like, dude, I stayed.
Yeah.
What else did I do? These are guys that close more than I do. You know, I'm like, I stayed and I constantly, and I never thought of leaving. The grass is always greenest where you water it.
Right.
And just, you know, to me, I'm a unicorn. I go do these speeches and stuff like that and at these conferences. And I'm like, yeah, first company I ever worked for was Ross Mortgage. Still here. And they're all just like, huh? And, you know, I mean, these are good executives that have on like their 4th gig. And I'm like, I don't know, man. Tim Ross is my mentor. He's taken very good care of me, and he never, ever, ever did me wrong. And I think that was huge, you know. And I think that's the biggest thing I want to go forward. People are going to come and go. That's going to happen. Loan officers will leave me. I don't care how great I am or how bad I am. They're going to leave me. But I never want a loan officer to say I did them wrong. That's my biggest thing, man. It's like, hey, listen, I go to bed at night. I gave you a good opportunity. If it didn't work, that's fine.
Right.
That's fine. But I want to make sure I can go to bed peacefully and say that I gave them all the opportunity and I didn't do them wrong.
Yeah. I remember I had a great conversation with a friend of mine, Baron, who is like savant at recruiting, and now he runs a region for an IMB. And we're just friends. Every time we're in town together, I'm down there in San Diego or he's in Vegas or LA, we have a cigar. And he's like, yeah, people leave companies because of one of three things: sustained poor leadership, sustained poor rates that are out of the market, or sustained poor operations. He's like, what you got to understand, Scott, is you got to be willing to put up with those at some point in your career for about 6 months, because companies are going to make mistakes, right? You're going to get paired with a shitty processor. There's going to be leadership changes in this business, as you alluded to. He's like, but just put your head down and work harder for 6 months, and 9 out of 10 times it'll fix itself. If it goes past 6 months, all right, now we're talking about stuff that can impact your career. But if you were to jump ship every time leadership or ops or rates had a bit of a struggle, you'll be changing companies every year and you'll never get like on a sustainable path to growth.
Yeah. And sales loan officers, they also, there's two words that I never try to use, but I can't say I don't always use them, but loan officers use them all the time. And it's just so bad. And it's always and mostly, right? And my COO, she's an awesome. My COO is awesome. Her name's Sherry Crump. She's amazing. And she's got this thing that she does, and it's called fact versus feeling. And every time she hears the word always and mostly, she'll literally dive in, do the research, and be like, okay, I just want to make sure I understand, because you were upset, and rightfully so. We made a mistake, right? But you said always happens. You did your last 13 loans closed inside of 18 days, and you had one that we made a mistake that pushed out. So I just want to make sure you understand that always is a strong word. Mostly is a strong word. And that if loan officers, although I totally understand getting mad about a loan that goes off the rails, if they just slowed down for a half second and realized, okay, yep, that one went off the rails. But you know what? 2 months ago, I put one off the rails and they got it back on and got it done.
Yeah.
And I think sometimes loan officers leave too fast.
Yeah.
I think they just, something bad happens and then it's a bad taste in their mouth and they just can't get over it.
Right.
And it happens, totally happens. But, and again, I mean, I would not want to have been my processors when I was 29 to 39.
Yeah. I tell my coaching clients all the time, I've got a lot of permanent scars on my knuckles from punching walls and doing stupid stuff. I mean, there's probably a concrete wall behind the Washington Mutual, which is now a Chase Bank in Burbank, that still has some of my skin on there, because I would get so angry. And I'm like, what am I doing? Like, finally, I don't know if my testosterone levels started going down or I got married and got more mature, but I was like, the house is not bleeding. Like, Debbie in processing wasn't trying to screw me. It's just like, it's gonna be okay. But like they say, age is wasted on the young.
100%. For me, it was my girl. I had a girl and a boy. I was still hot-headed, and then when I had my second girl, I was like, okay, I'm a girl dad now. So like, just calm down, man.
Yeah.
Now I got three girls, and it's like, okay. Now I cannot just be Mr. Macho guy and just start banging walls and throwing chairs.
It's never worth it. You mentioned the retention. You've had the benefit, again, longevity at the same company, only company, growing from loan officer assistant all the way up to the president of the company. What are some things that you've seen? Like, if there's a mortgage leader watching this podcast, what have you seen as some of the most powerful things that do make people stay or do make people go, right? And this could be whether you run a mortgage company, a real estate company, like, what are the cultural things where it's like, hey, this creates longevity? And, maybe if you want to get vulnerable, hey man, this is where I made a mistake and it cost us a key team member or something to that effect.
Yeah. I think the two biggest things that leaders can do when it comes to retention is, one, you cannot get angry when someone leaves. You just can't. This is such a small industry. I pick and choose when I'm going to be upset about someone leaving. The bottom line is, these people, the majority of loan officers are, I'm at a point now where I almost just get worse when a good operations person leaves. I mean, what I've told my loan partner and others, is that when people, it's the optics of a good loan officer leaving that crushes the president, owner, whatever of the company. That's what crushes them, is the optics, right? At the end of the day, if a $20 million producer left, well, you can go get $4 or $5 million producers in like a month. It's the optics, right? So don't let the optics kill you. People leave. It's part of our industry, right? The other thing that you have to be as a leader is you cannot. My biggest problem when I first became president of the company is I was so afraid of failure. I was so afraid of failure that like I didn't let anyone do their job. I would do everyone's job because I was so afraid of failing, and I knew that if I did it myself, at least I controlled my own failures or successes. If you're going to be a good leader, Steve Jobs was my guy, man. I've watched every movie, read every book. He always said that when he felt the best is when he was the dumbest guy in the room. You know, you do not want to be the smartest guy in the room. And when you're a good leader and you start hiring people based on skills you don't have and then let them utilize and use those skills, that's when you're going to start to really succeed. A lot of times leaders want to hire people they get along with and they're just like them. What for? You already do that part. You know, we started doing the DIS test about 5-6 years ago. And I mean, if I'm going to hire an executive or if I'm going to hire an operations person, I want them to be the opposite of me.
Right.
You know, and then I want to let them do it. You know,
which is so hard because like if you're a high D, high I,
so hard.
Yeah, like if you're a high D, high I on the DIS test, which for people that aren't familiar with that or didn't used to work at KWs, it means like you're a driver, you're intuitive, you're gregarious, you're outgoing. And then you interview somebody who's a high SC and they're kind of quiet, they're more reserved, they're like an accountant or a chemist. Like you're not going to vibe over a drink or in an interview, but that's also exactly the person you need to complement
100%.
What you're doing. And that's very hard to get like that. It's hard to wrap our mind around that as human beings of like, oh, to build a better tribe, I got to find people that don't look exactly like my tribe. That's not human nature.
No, I mentioned Sherry earlier in this call, and we did the DIS test, and my business coach was literally saying, "This is who you need to hire. This is who you need to hire." And I'm like, "Yeah, but the other one and I get along so well." Da 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 da. Long story short, she wins. I hire one of the best hires I've ever had.
Yeah.
But I'm telling you, at the time, I was like, man, I don't even know if she likes salespeople, and I'm kind of a salesperson. And it turns out she loves salespeople. But my point is, I'm like, man, reading this DISC result, we're so opposite, and you know, it's taken a while to be sure, but we've got a great relationship and we work really well together. But it's so crazy how like leaders have got to let this stuff go because you're never going to grow doing all the work yourself.
Right.
You can only get so big if you're going to do everything yourself.
Yeah.
You know,
you and I have seen a lot of companies that, you know, they seem to go down one of two rabbit holes where everything is about the top producer. They're only focused on that. You know, to your point, the leaders are micromanaging everything to try to placate the top producer, and it pushes out everybody down below them. Or on the other side, they're trying to micromanage all, like really get into the weeds on the things that aren't going well. And they forget to keep courting their top producer and making sure that person stays there. So I've seen it in both ways. You know, going back to your admission of micromanaging back in the day, where have you made some mistakes? Like where are some cautionary tales for young leaders in the mortgage space?
Well, I'll tell you, in my late 20s and early 30s, I was very cheap to my partners, to my loan officer assistants and stuff like that. And I lost some really good ones. So I definitely think understanding that at the end of the day, you're making, as a loan officer who works for an IMB who doesn't have a call center or anything like that, you're making between 40 and 50% of the revenue. If you got someone literally doing all the, I sometimes these loan officers say, well, I just bring it in, and then they're supposed to do it.
Right.
Don't ever forget who makes the most money, and don't think for a second that the people you're sending it to has the same attitude about that loan that you will. You won't. If they did have the same attitude about that loan, along with their skill set of being able to put that loan together, they'd go and outproduce you. But they never will because they don't have that attitude, right?
Right.
So I think taking care of the ones who take care of you is something. And then the other thing that I struggled with big time was the listen first, talk last. That one took me probably the longest, and that's still a work in progress.
Listen first, talk last. I like that. Tell me more about that.
Yeah, I mean, it's so many times ideas can be pulled out of your head and implanted into someone's if you just give them a chance to talk. And when it's someone else's idea, nobody wants the leader to have all the ideas.
Right.
Like if you're in a room full of your executive team and you always leave and it's always your idea or it's always your way, then they start to feel kind of pointless, And I think it's so important that if first off, we're all, most leaders in this company, we're business owners, right? So we do all have to, basically take care of the business. So, I mean, anything that's just, you got to make a decision, make your decision. But when you're trying to run a company, you get so much further ahead if you let other people come up with the ideas.
Walking that fine line, it's like, I definitely have not perfected this. I am not good at this of, okay, when do I need feedback, input, run with the ideas of other people on the team, let them try and let's see if it works better than my idea or if it fails. And then there's certain times as the leader or the person signing the paychecks where it's like, no, this is going to be done this way. Kind of like dad just said so. Right. So it's like, where do you become there's that old joke, I'm a communist at my dinner table, I'm a socialist in my community, and I'm a conservative at the macro level. When do you decide oh yeah, I'm part of the board of directors versus I'm the dictator, right? Because sometimes the business decision just has to be made and we don't have time for input, or maybe you do have the best way to do it. But how do you straddle that line of I want input, I want to listen and then talk last. And oh, by the way, sometimes your input will not be as valuable as my input, and I'm the president and this is just the direction we're going to go. How do you manage that? Yeah, it's terrifying. It's like I always want Chris's input because he's more creative than me with the podcast and the social media and stuff. And then sometimes I'm like, hey, this shit just has to get done. Just do what I said for the next hour because I'm in charge.
I think here's the thing. When I said listen first, talk last, not if you're going to leave your way. I think if you're going to leave the meeting with your idea and nobody else's input, then just do it. Don't waste their time. Just do it. Hey, you know what? I got an idea here. This is what it's going to be. I want to try it. I'll make you a deal. We're going to do this for 90 days and you let me know if I'm wrong. If I'm wrong, then we'll come in and reconvene. The other thing that a lot of leaders are afraid to do is have constructive conflict. So I had someone on my executive team that always wrote me emails like this, right? And I would leave. I wouldn't read it, obviously,
right.
Not chance. And then I normally would complain about it, and then we'd move on. But it was really important to this person, and they spent a lot of time working on it. So I had this business coach one day goes, why haven't you ever said anything? And I go, well, what do you mean? They're like, well, why don't you just tell her how you want it? And I'm like, okay. And she goes, well, just try it. So I literally called her one day and I was like, hey, I'm like, you work so hard on these emails and I know you put a lot of time in them, but I'm telling you, I'm not reading them 100%. Do me a favor, 5 bullet points. I just want 5 bullet points. And then make the first 3 really good because I probably won't read 4 and 5. That's what I said. I felt horrible saying it, but that's what I said. And it was a breakthrough for us, because saved her a ton of time because she was trying to give me all this explanation. And again, I think it's just one of those things where, it's okay to, as a leader, to say, hey, this is my form of communication. We got to do it this way. I can't have 6 different forms because that's what you like, that's what you like, that's what you like. I like it this way. And if any one of you want to communicate with me, let's do it this way. And we're all going to be better for it because you're not going to be mad that I'm not reading your emails. You're not going to be mad that I don't have a clue what you're talking about when you talk to me about it in a week. And I'm going to know and I'm going to respond and everything's going to be good. And then anyone else, you can write however long, you can write a book to everyone else. I don't care, right. But this is just how it is. And I think sometimes leaders, they're afraid because they don't want to make people feel bad or something like that, but it's not always roses, constructive conflict is great. And then I always allow, I have this one meeting I have every Wednesday, 10:30, and I've got these 4 executives that are in it. It's a separate meeting. It's just me and them. They're my team. They're my squad. And we call it Vegas. I can't get mad. They can say whatever they want, do whatever they want. They can tell me, what I'm doing wrong. It is because, and it's been a great meeting because it's one of those things where they know going in, okay, if I got a problem, I'll save it for that meeting and I'll talk to them then. We don't do it in front of anyone else. It's just in this one room. We do it. It's in my office. And it's been great because we've solved so much conflict so much faster and instead of letting it just fester.
Yeah. Do you burn some sage? Do you burn some sage after every meeting and cleanse the room?
Yeah. No, I just usually lick my wounds and, just go to lunch.
I like that idea of the constructive conflict because I can use all the players in this story I'm about to tell you because it doesn't matter. My friend Shada, who's now a top producing loan officer at Wells Fargo, she's really found her niche. We worked at Prospect Mortgage together when she was like fresh out of college, right? She didn't know what she didn't know. And I was a new leader, didn't know what I didn't know. And this is the only time I've been written up in my mortgage career. She would come in every day and be like, so Scott, I've got this situation, with a realtor or client or a problem or whatever. And she'd explain the whole thing and waste half an hour of my time. And then I would say, okay, well, the way that you should solve that is you should do A, B, C and have this conversation and whatnot. And she's like, great. So what I'm going to do is I'm going to go do and one day I was just at my wit's end and Tim, I fucking lost it. I was like, how dare you waste a half hour of my time twice a day? You come in here, you can do one of two things. Go do it your way, and I'll be here to help you pick up the pieces, make the tough calls, save the deal, restructure the file when you screw it up. Or tell me the story and then do it my way. But what you don't get to do is walk in here, waste a half hour of my life, and then do it the way you were going to do it anyway. If you need a sounding board, go talk into your recorder and then listen back to it, right? Like, I was so mad. I might have used some foul language. She was a young girl. It was not good. Somewhere, luckily, Prospect Mortgage doesn't exist anymore because that was in my permanent file. But I was not equipped at that time as a leader to have the constructive conflict conversation and just say, hey, man, this is the way I like to be communicated with. And here's the problem. You're really just wasting my time. You want to do it your way anyway? Go do it. It's cool. Like, no shame. And then if it blows up in your face, I'm your boss. I'll be here to help you pick up the pieces and figure it out. And I wasn't ready at whatever it was, 30 years old, to be that mature. It was more fun to scream and yell and almost lose my job.
Yeah, I bet we could sit here for another hour. I can tell you stories of times where I went home to my wife. I was like, so will you polish up my resume? I really shouldn't have said what I said today, So
yeah,
I think it's just part of our personality, and we get so into it. And especially back then, because back then the units were these loan officers today, and I hate sounding old or like an old grandpa saying that, but like 5 loans is good. I mean, we used to do 20, 22, 25 a month, have pipeline meetings every single day just to keep up with this stuff, Right. And I think that, can you imagine with these numbers? Well, I know people that do it, but guys that are still doing 20 and 25 loans a month, they're murdering it.
Yeah.
They might as well be an IMB.
Right.
It's just crazy, right? Like, I just think that it's tech has made us, I don't have a problem saying it. Tech's made us lazy.
Yeah.
It just has. It's made us lazy. We think that everything should be so fast and so easy. And yet this is still such a complex industry. Guys, there's a reason why the push button get mortgage epically failed.
Right.
Because it doesn't exist. It doesn't exist. It's too hard. I love when people brag about their company who did a 7-day close. A 7-day close. I had one of my loan officers brag about a 7-day close. I just saw it before we come on. I'm going to send her a text and be like, you did a 7-day close. I didn't. You originate every loan like that, and I'll close every loan you got in 7 days.
Right.
Like, I appreciate you putting it online that we're awesome and everything. Trust me, I'll take it. But I don't close every loan in 7 days. I close loans that were originated like that in 7 days, And it's like any company can close a loan in 7 days if you just originate the hell out of it and make it a one touch and do everything right up front and don't mess around. I used to tell this guy, he came and worked for me for a while. He's a good dude, young kid. And he always struggled. He struggled. He had tough loans. And I used to say to him, I do these loans. He's like, what do you mean? I'm like, well, I do 620 loans all the time. He goes, oh yeah, they're so hard. I'm like, I don't seem to have as much problem with them as you do. I'm like, the bottom line is if you're going to do a 620 loan, you better originate the hell out of it, and then you can make it easy. But I love these loan officers and these brokers that just brag about these companies that do loans in 7 days. Boost your own ego. You did it.
Right.
We processed it, underwrote it, and closed it the exact same way we do every loan that goes through our system. We didn't do anything different. We just had to look at it once. That was it. The only difference,
Amazing what happens when you take like a full application, right? I mean, I've been hearing this for 25 freaking years. Take a full application, ask the questions, know the variables, explain the story, and your underwriter will only have to touch it 2-3 times, maybe once, right? And it's like, it's not that hard. When I was managing a bunch of loan officers at New American, inevitably I get the call. Yeah, everything sucks. Blah 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 blah. We're closing late. They always close my loans late. I'm like, okay, let's slow down. Let's go take a look. I'd go in the file, and sure enough, every single time, without exception, and I can say every time, that a loan officer was blowing me up about how horrible we were as a company and how this underwriter was out to get them and processing doesn't give a shit and nobody's working hard on the deal. I would look because it's in Encompass. I'm like, well, wait a minute. The offer was accepted on the 11th. You didn't submit it. You didn't submit it to ops till the 27th. So what happened in those first 16 days of the transaction? Oh, and by the way, from day 17 until the day we're supposed to close, there was a federal holiday and 2 weekends. So you basically gave us 4 business days to close a loan. And they're like, well, the client was really slow getting the paperwork back and the disclosures. I'm like, cool. So we don't have a company problem. We have a communication with your realtor and the client problem of you should have been telling them on day 3 of the transaction, hey, boss, we're probably going to close this one late because the client still can't figure out how to sign their digital disclosures. Here's the solutions. Here's what we're working on. I'm just letting you know we're going to probably be closing this one a little bit late. And they're like, well, I can't do that. I'll lose the relationship. I'm like, well, you're not keeping it now because now you got to throw your company under the bus, and you do that 4 or 5 times. Then you got to change companies because you've lost all faith from your realtors, right? And I didn't figure this part out until I went into leadership. So another growth moment for Scott Groves, I guess.
I like it.
Being the president of a company, which there's not so many of them left anymore, what's been most eye-opening from you, whether it's on the managerial side or the how things operate behind the scenes, the stuff that happens behind the curtain, what's been most eye-opening for you or the steepest learning curve, maybe is the way to ask, moving from just originating loans to actually managing a real IMB that's producing some serious volume?
That one's easy, man. It's 50% of the loan is done for the IMB at closing. That was the biggest thing.
Tell me more.
I really did think they packaged the loan, they sold the loan got bought, you were done. It is that loan stays with you forever. It's the amount of work that goes into the loan after it closes was by far and away the biggest eye opener for me. The other massive eye opener for me that I want every loan officer, if you want to be a kick-ass loan officer, to do is learn secondary, learn the markets, learn what's going to happen. I mean, I never knew what was going to happen. I mean, I thought I'd look at the 10-year,
right,
and I'd tell you, how many times I called secondary, a young whippersnapper going, dude, we got 50 basis points today. Where's my 50 basis points in price? Dude, the investors are 2 weeks ahead of us. If we get 50 basis points today and the investor knows we're going to give it back in the next 2 weeks, you think they're going to give it to us? And so many loan officers are like, market's gotten better by 100 basis points. Why is our pricing not? What are you doing? I'm like, nothing.
Right.
There's no more than these guys pay economists to sit in freaking dark rooms and figure this stuff out for the next 2 years.
Right.
They're not just going to, if it was that easy, we'd all do it. I mean, if it was just, it goes up, it goes down, and we get everything based on what it goes up and down, it'd be super easy. So learn secondary, and man, love your post closer because their job never ends. Yeah.
I remember during the mortgage crash, there would be these articles about, oh, well, Fannie Mae and Freddie Mac just has these, airline hangars full of auditors that were going back trying to push loans back to the company. And these might be loans that were around for 3 or 4 years that were performing, no late payments, anything. And they're like, well, Tim, we didn't really like how you documented those gift funds. So yes, every single payment has been made on time for 4 years, but we just don't want to hold this debt on our books. It's yours now. And it's like, wait, what? Like, this is a problem we could have solved 4 years ago. You guys didn't catch it. You never audited. The loan's performing. What do you mean you pushing it back on us? So to that point, like, what is your guys' exposure as a company once you write a loan? Is it forever?
Forever.
That's so crazy to me.
They'll say it's not, but it is. 100%.
That's so crazy.
I closed the loan. I'm going to close the loan tomorrow that, I had to buy back a completely current, perfect loan this will actually make you laugh. I had to buy back a completely current, perfect loan because they didn't like the appraisal. Shame on us. We thought we did the due diligence based on the CU score, but we didn't. And I can't even believe I'm saying this, but we ended up refinancing the guy because that's what we had to do. So we refinanced him a month or two later. We got a PI.
All right. So for people that don't get that joke, Tim did a loan.
That is truth.
Tim did a loan. They got a real appraisal, and the appraiser went out there, evaluated the value of the house, brought it back, a lot of human work, and Fannie Mae, I'm guessing, or the investor is saying, well, we don't like the appraisal.
18 months later,
came back and said, in a appreciating market, which we've seen for the last 18 months, we don't like the appraisal, buy the loan back. And then when you went to refinance it, the same automated system said, actually, you don't need an appraisal. Here's an appraisal waiver because we know the value is well supported by the surrounding comps and the other appraisals that are in the system in that neighborhood. So you don't even have to do an appraisal. But like, what a cluster for you guys to have to do that.
Yeah, that was the biggest eye opener for me, is that it's never over. The loan officer closes the loan, gets paid, their job's done, and God bless them. That's how we make our money, and I love them for doing it. But man, that thing never leaves.
Oh man, how do you insure against something like that? Like, a trendy. You can't. Because I would say a trendy term right now, I'm getting called by all these recruiters because that's what recruiters do. And they're like, Scott, did you know that we are privately owned and we have $100 million on the balance sheet? I'm like, well, I have no idea what that means in relation to your peers, or if that balance sheet actually matters, or if you guys are just hoarding cash, or if you have $100 million balance sheet because that includes your CEO's $12 million home. None of this matters to a loan officer. But is there a way for you to insure against that risk, or is it just like every day we write the best loans we can?
Every day we write the best loans we can, and every loan we close, we have a loss reserve scalped out of it. So it's literally for that.
Couple $100 to pay for the scratch and dent and the errors and stuff like that.
100%. It's just a loss. It's a loss loan reserve that we do on every single loan. Again, another one of those expenses, right? That we have to have. And and then also, keep in mind when things are busy, you never hear from these guys ever, ever, ever.
Right.
Because they're just as busy as we are. When we get slow, someone in DC at Fannie Mae, which I've been to both Fannie and Freddie, they are the most beautiful buildings I've ever seen in my life. If anyone tells me they're not making money, then I need someone to prove it to me, because those buildings are gorgeous. They might as well be made out of marble.
Yeah, well, it's easy. It's easy to make money when you can privatize all the wins and socialize all the losses. That's
exactly.
Duh. If I could run my life like that, be amazing.
Exactly. And it's just part of doing business. There's a enormous risk of being an IMB, but you know what? During good times, there's an enormous win too.
So give me an eye-popping number. We were using some round numbers, 2.5, 3 points. Let's say there's a $500,000 loan that your loan officer makes 100 bips. You guys sell it, however that happens, and you get kind of your servicing release premium, and you get all this stuff. So you make maybe 3 points on it. So you guys make as a company $15,000. Loan officer makes $5,000. What's like the biggest risk of ruin on a $500,000 loan that goes sideways or has to be bought back? Like where are you on the hook when things go really, really bad on that $500,000 loan?
Our biggest one, it doesn't matter what our biggest one is, but the biggest problem is when the scratch and dents don't want it.
And what does that mean? Describe the scratch and dent to somebody who's not heard of that world.
So an IMB gets a buyback. You got two choices. You can either refinance them if rates are going good. It's never really an issue. You just refinance the person and call it a day. But when the last 2 years rates have been horrible, so you can't refinance them, so you got to go to scratch and dent. Scratch and dent are companies that are backed by hedge firms that will just buy these, and they love them too, because a lot of times it's football. Like you said, it's a current loan. Everything's great.
Yeah. So let me just set the table. You write a $500,000 loan a year ago. Everything's fine. The client's making their payments, whatnot. Fannie Mae or the investor or B of A or whoever comes back and they're like, Tim, we paid you 3 points for this loan, so we gave you $15,000 on this $500,000 loan, but we don't want it anymore because we decided the way you guys calculated income's a little bit out of our guidelines. Yeah, we know the client's making their payments, but we don't care. Here, take your loan back. We want our $15,000 back. So you give them their $15,000 back. Now you have this loan you have to sell to one of these hedge funds that will do the scratch and dent. And for them, it's a great deal, right? Because they get a loan at a cheaper price that they know they already have a track record that the client has a history of paying their mortgage.
Yeah, and sometimes that equals 88% of the loan.
What?
Do the math. Do the math on that. Yeah.
So you buy a loan back for $15,000 and then you only get to sell it for like $2,000, $3,000, $4,000?
No, you buy a loan back for $500 and you only get to sell it for like $420.
So you lose $80,000? Holy God.
You can. I'm really, really good at these things, so I haven't, but I've heard horror stories. Yeah. I've heard people selling it for literally 70%. Yeah, you got to buy the whole loan back. You don't just pay the premium back. You got to buy the whole loan back. So not only do you lose out on whatever you get out of the scratch and dent, you also lose the $15,000 you made on it.
Oh.
Yeah.
I feel so much worse now for this one jumbo loan that I did. And we were really pushing some buttons on this one. And I was at Movement Mortgage at the time, and they did have to buy it back. And I think it was $100,000 check they ended up writing to sell that 100%. Scratch and dent.
100%. Happens all the time.
Oh,
happens all the time.
So what's the upside then? Are there moments in the market? Because like you guys are taking all the risk for the downside, and I don't mind telling loan officers like shut the fuck up and quit complaining because you don't have the capital to do these kind of things. So are there times when the margins are healthier and every company is busy and the servicing companies aren't trying to eat your lunch by retaining everybody with the call centers? And you're like, hey, on this one, we hedged correctly, we gambled appropriately, and now we're going to make 400 basis points on it. Like, is there upside, or is it just like you're always getting eaten alive on the downside?
There's always, we wouldn't be in it if there wasn't an upside. Right. I mean, if you really think about it, people want to talk about 2020 and 2021 because the common loan officer was making $200,000. We had a run from 2010 to 2022. We had a 12-year run where the majority of IMBs were profitable. In the mortgage industry, that's insane. In the mortgage industry, you're hoping for 3, 4, 5 profitable years and 1 or 2 down, right? And then 3, 4, 5, 1 or 2 down, 3, 4, 5, 1 or 2 down. To go 12 years profitable, I mean, we had a run that was insane. You know? So I wasn't that, I mean, I was surprised at how high the rates got, but I wasn't that surprised that we were going to have a 2-year clean out at all. I mean, again, my mentor, Tim Ross, by the grace of him, we were never greedy in 2020 and 2021. I mean, we put it all back into the company, and thank God we did, man, or we wouldn't be here.
Right.
And we didn't buy the yachts, we didn't buy the cars, we didn't buy anything. We just were like, you know what, we're going to make what we made in 19 and let's go on. And just throw it all in there. And that's why we're still here today. So that's, I think the ownership, you asked, how do we last so long? I put a lot of that on Hugh Ross and Tim Ross. That's why we're still here, because they just, during good times, they taught me a long time ago, man, you're going to make this sometimes and you're going to make this sometimes. But if you live here the whole time, you'd be here for a long time.
Yeah, that's so true, because there are a lot of companies, and I won't use them by name because there's no need to, but there's a lot of companies who were telling their employees, hey, we can't spend this money, or you can't take that concession or whatever because winter is coming. I've had this. Yeah. Hold on. Oh, shit, I just dropped the fan. Can you come grab this fan, Chris? I've had this little winter is coming. For those of you who are listening to the podcast, it's a Papa thing. These little, what do they call these? Papa-matics? Papa something or other. I don't even know what these are called. Anyway, it's the Night King, the Ice King from Game of Thrones. And I've had this on my desk for like 5 years because I knew winter was coming. But there was a lot of companies who were saying, hey, we can't do this. We can't spend this money because winter's coming. We've got to have a war chest of money for a couple years, a couple down years, because it's going to happen. Yeah. And then all of a sudden it was a down 4 months and they're like, yeah, we're out of money. Like, we gotta lay off all your people and fire. It's like, wait a minute, what happened to the 12-year war chest of money? And like, my regional manager just bought a $3 million house, a racehorse, a Lamborghini. Like, what happened to the war chest? And it's like, well, we kind of know where the war chest went, right? Yeah. And I really, really applaud you guys for doing that, right? And like actually saving the money to weather the times. What are you looking forward to in the mortgage business, right? Going forward, like, when does it get better? When do we think we're going to see some chance to refinance it? And look, we've all been very wrong the last 3 years on what was going to happen, sure. The ups, the downs, the goods, the bad. But, you've got to do strategic planning for your company. What does your crystal ball say? I mean,
I can tell you one thing. I don't care who wins the election.
Neither do I.
I don't think the rates can sustain where they're at. I really don't. I think that based on the economics thing that I look at, I think first off, I can't believe the media. I have to go out and get my own information. I believe that if the rates sustain and inflation sustains the way it's at, I don't see how we don't hit a recession. And anytime there's a recession, rates go down. I think the reason why people are afraid to admit that is because the last recession we had was like the death of the world.
Right.
So they think, I mean, we probably had 4 or 5 recessions prior to that weren't that bad.
Right.
They were just setting the, resetting the numbers. So I think, in my opinion, I think we're going to have lower rates in the fourth and first quarter. I think they'll get decent, like good rates, middle of next year is what my opinion is. I think that if one side wins versus another side, the decent part might happen quicker. Oh, I don't care, man. I'll say it. I think if Trump wins, I think the rates will go lower quicker, but I don't think they'll spike down. He can't do that. I mean, the economy couldn't handle a spike down in rates.
Right.
But the biggest problem I have is the people who are like, well, when I bought my first house in 1980, the interest rate was 22. Bro, you bought your house for $40,000.
Yeah.
I'm like, that's not the same. An 8% interest rate on a $450,000 mortgage is crippling.
Right.
I mean, it's just so I think my biggest grab my popcorn moment and see what happens. No matter who wins the election, what in the heck is the government going to do about affordable housing?
Yeah.
You have got graduating kids year after year, year after year, year after year, not even thinking about owning a home. That's not good.
Right.
That is not good, man. I graduated college. I couldn't wait to buy a house.
Yeah.
And I mean, I think to me, that's the thing that I want to, again, get my popcorn and watch. What is the government, no matter who wins, someone's got to do something about affordable housing. You either got to convince builders to build smaller homes and make profit on them. You got to give sellers huge stipends, knock down capital gains, 100 different things you can do, to do it. But you got to do something, man. You got to do something about that, because affordable housing is just, it's make houses affordable is what they should say.
So I have a theory about this. Help me troubleshoot it or poke holes in it. And I thought about this after I read the book, The Dictator's Handbook, which is really just a great breakdown of everywhere from the atrocities of Hitler, Mao, whatever, all the way down to your local city politician. Everybody's just working in what they think is their best own interest. And sometimes that pans out, sometimes it doesn't. But especially when we talk about politicians, everybody's just working their own self-interest. And when you think about it that way, it's like, yeah, I'm constantly working in my own self-interest, what's good for me and my kids and whatnot. And on this particular topic, there is a lot more voters who are potentially first-time buyers or renters or whatnot. And so what the government keeps doing, whether it's tax policy at the federal level, grants at the state level, tax write-offs for buying your first home, Cal FHA down payment assist, all that shit is geared towards the wrong side of the curve. They keep going on the demand side of the curve and being like, well, if we can just juice buyers for an extra $5,000 and give them $5,000 down, or we can give them an extra tax break. The problem is not the buy side of the equation. The problem is the build and housing side of the equation. The problem is there's way more voters who are renters than there are voters who are developers and contractors. And so my thought is, because we keep incentivizing the wrong side of the equation, the supply and demand, this is going to be out of whack forever until, and I don't know who it's going to be, some wildly popular governor, maybe it's somebody like DeSantis, who feels invincible, goes on a crusade where they're like, hey, we're going to incentivize developers, $25,000 a unit for every piece of housing, unit of housing they bring online in the next 5 years, right? And they'll get crucified in the media because it's like, oh, they're just giving a tax break to the evil rich developers. And, the owner of Kaufman Broad has 17 houses. Why does he need a tax break? It's like, well, they need a tax break to be incentivized to build housing. And I think until we get a governor that shows like proof of concept over 5 years, this problem is just going to keep getting worse and worse because they're incentivizing the wrong side of the equation. So thoughts on how smart or stupid my comments just were?
I think they're really smart. I think you're absolutely right. People do. I mean, like people shouldn't vote. I've always said, don't vote Democrat, Republican. Find the two people and figure out what best suits you, right? Like, I mean, Obama was great for the mortgage industry. Trump likes the mortgage industry. There you go. We're in the mortgage industry. You do the math.
Right.
You know what I mean? I think that, but you're absolutely right, dude. We have to incentivize homes to be put on the market, not buyers to come out and buy. We got plenty of those. We got plenty of those. I think you're absolutely right. I said find a way to let, like, if I have a 3.5% interest rate on a 30-year fix, find a way that I can sell my house, buy the next one, and keep the rate.
Like a transferable mortgage.
Yeah, the guy who buys my house has to pay it off with a normal loan, but I get to take this loan to my next house and buy it at that rate, or find a way that I can, or start making the 3-2-1 buy downs more affordable, or something, like there has to be I have to be given a reason to want to sell my house. I mean, I love my house. Like, my kids love my house. My wife loves my house. And I got 4 years left on a 15-year mortgage. I didn't even refinance in 2020. Right. And I'm not moving, because why would I? It's going to be paid off soon, but if they gave me some crazy incentive to sell it, hell yeah, I'd sell it. If in 1 year, my son goes away, I got 4 kids and it's too big of a house.
Yeah.
So I mean, like, but in the meantime, it's too big of a house, but anything else I'm looking at is far too expensive. I'd never pay for it, and I'm just going to stay there. I think you're absolutely right. I don't know how to do it, but I think you're absolutely right. They need to incentivize the sellers.
Yeah, sellers and builders.
I'm going to go off cuff here and say that my battery's going to die soon, and my wife is killing me for not being where I'm supposed to be.
All right. Well, let's close it up on this one question, because this is the most important question of the podcast, and I feel like I can learn a lot about somebody because I'm a movie junkie. What's your favorite movie and why?
It's so hard. I have to be original to myself. Caddyshack. I have to.
So I got that. I got that going for me.
Yeah. Gunga Galunga. Yeah. Caddyshack all day long.
If people haven't seen Caddyshack, that like monologue from Bill Murray. So I'm caddying for the Dalai Lama. It's just so classic, and I don't know why it sticks in my head, but it's just hilarious.
So I got that going for me.
So you can put that in from Bill Murray. I got that going for me. Hey, Tim, thanks for being on, man. I really appreciate you. We'll talk soon. I think some of your predictions are going to come true. Then we'll repost this in about 6 months when we're like, look how smart Tim and Scott were, and we'll go from there.
I love it, man. Thank you so much for having me. I really appreciate it. Let me know when to watch.
All right, man. We'll talk soon.